The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
For over 95 years, we've set the bar. Power, we restored it. Protection, we reinvented it. Record yields, we redefined it. If there's one thing we know at FS, it's that just because something hasn't been done, doesn't mean it can't be done. We're never satisfied unless we take your farming operation to the next level. Run your equipment at peak efficiency and bust the bins this season. Visit fssystem.com.
Well, as we work our way through a holiday week, it's always quite interesting to see the trade action as we work through Thanksgiving and a shortened session on Friday. But overall, we kind of have the factors in play that we know are going to be in play here in this market trade. And so let's break a few of those down as we're nearing the end of the year. Joining us for a conversation, Chad Hart with Iowa State University. Always good to talk with our friend, Mr. Hart. Chad, it's good to talk with you, as I mentioned, and thanks for making some time to join us here. Hope you're doing well.
It's my pleasure to be with you, Jesse. Hope you're doing well as well.
I'm doing good. And this market trade's been quite interesting here as of late. A lot of volatility from South American weather. It seems like we've re-entered a weather market, but it's all tied to the southern hemisphere, and soybeans have kind of been the driver in this complex that have had the most bullish story, I would say. It's an interesting time of year when you get around the holidays and you get a few different stories here or there that can really kind of propel these markets, can it, Chad?
It really can. And I'd say this is a change from, say, 5 or 10 years ago. When you think about this time of year in the soybean market a decade ago, it was still concentrating on finishing up our harvest. What does our production look like? You look now at this time around, it's all about South American weather. How's the planting going on down there? And in fact, trying to decipher what's happening in the northern part of the country versus the southern part of the country. And it's because of the tremendous growth in production that they've had over the past 10 years. I mean, when you look at where Brazil has come from, where they used to be number 2 in production, well behind us, to now they're number 1 in production worldwide, and a good 40 to 50 million tons more than we do. I mean, it's incredible the growth that they've had.
It is definitely incredible the growth that they've had. And I think about some of the shifting deck chairs. You and I have talked about this before with China going to Brazil more to buy soybeans, and then seeing, some of the problems that Argentina we've had with drought and leading to maybe some more crush here in the U.S. and U.S. becoming more of a soybean meal exporter, et cetera. There's a lot of dynamics that have been shifting and at play here in this soy complex worldwide here the last couple of years, Chad.
There definitely has been. When you look at USDA's longer term projections, they continue to show that, the idea of the growth and crush that we're seeing here domestically looks to continue on for the next several years as we look towards more biofuel production coming out of vegetable oils like soybean oil. And as you mentioned, that brings up, what changes do we need to see within the soybean market? We think traditionally of, usually half the soybean crop gets exported, the other half gets utilized here domestically. Well, that buildup and crushing means that we're going to spend more time and spend more of our soybeans here domestically, limiting our potential growth as we're looking at exports. And sort of, as I've described it, as we're moving from a Brazil type model for soybeans, where you spend the majority of your time and your beans on the export markets, to more of an Argentina style where they don't want to sell you the beans. They want to sell you the meal or the oil. They want to look at that crush complex and give you the products as opposed to the raw ingredient.
Speaking of Argentina, that was something that kind of came up in the soybean market too early in the week. The election of Javier Milei, the far libertarian candidate to president in Argentina, and the talk that he wants to make their economy, get rid of a central bank, and tie it more to the U.S. dollar. And I know That could long term be a little bearish for the US soybean market, it would seem. I don't know how much you've examined that situation, but maybe you've heard some of that chatter in the news wires here throughout the week, Chad.
Definitely heard it, and it's something that when you think about it, it's not necessarily bullish or bearish, but it just depends upon the situation you're applying it to. And so when you think about what Argentina is talking about doing by moving straight to the dollar, it is eliminating, let's call it a potential source of volatility when we look at the export markets. As it is now, when international customers are looking at buying any product from either the US or Argentina, they have to take into account that exchange rate difference between the two. With Argentina linking to the dollar, that disappears. But what that also means is, okay, there were times when we would see the dollar strengthening versus their peso. That tended to hurt us in the export markets. That means that won't happen anymore. But it also means when the dollar gets weaker, we're not getting that benefit versus them either. And so that's sort of the challenge here of it's going to take away that extra source of volatility. At the same time, too, though, what it also does is it ties Argentine agriculture to U.S. agriculture because we're all reacting to the same currency risk.
Well, in the short run, I know that's again kind of a longer term export type story. In the short run here, as we wrap it up harvest, soybeans, this market got some pretty good premium in futures. I know some folks are taking advantage of basis, and it's been interesting. We got some carry in these markets right now, Chad, and you look at the products, meal and oil, inverted here right now, or have been inverted, and it's quite an interesting dynamic, and I wonder if this is leading to, or could lead to before the end of the year, more farmers selling, taking advantage of where this soybean market is at right now here in the U.S., Chad.
Well, that's the deal. I think the market is trying to entice farmers to move those beans into the marketplace as soon as they're willing, because as you mentioned, the idea is the demand for the products is definitely strong right now. We've been building more of these crushing facilities. Let's face it, if you build a new facility, you want that puppy up and running as hard as it can. So there's a definite pull happening right now on the soybean market, trying to get as many beans coursing through the system right now domestically. And we're also seeing a little more export pressure than we have been over the past several weeks, especially now that China has decided to step into the market a little stronger here over the past couple of weeks. That has helped boost our potential sales looking forward there. That feeds in with what we were talking about with the South American weather problems down there, leading to some additional sales, helping us wrap at the end of the year here on a stronger note for soybeans.
And I wonder too, with those China sales and the soy market overall being, fairly propped up, helping out with some of that farmer selling, I would think here in the U.S. But largely, feels like some of the China sales, is it just catching us up to where we should be this time of year? Because up to this point, Chad, export sales have just not been that great.
They haven't been that great, and I would say yes, it is just catching us up to where I won't say where we should be, but closer to where we'd like to be. And it's not just China. We have seen some additional sales in the countries like Mexico, the European Union. We're seeing some gathering momentum here when I'm looking worldwide. Because I think part of the issue, and this is not limited just to soybeans, but this has been a problem across all the ag complex, is that we've had concerns from our international customers about just high prices in general. The inflation scare that we had here in the U.S. was something that was felt worldwide. And so we did see export sales for a lot of commodities fall off over the past year to 18 months. Now we're starting to regain some of those sales back because of the lower prices for more commodities, helping buy some of those back, but also some strong need out there. And that's where soybeans really leads the charge. Global demand for beans remains nearly as strong as ever.
We're having a conversation today with Chad Hart from Iowa State University. Chad, let's go over to this corn market. Cord's been tough here the last couple of months. Soybeans have done their best to kind of pull corn along at times while wheat acts like a boat anchor here. So cord's kind of caught in the middle. It's the best way I could describe it. You look at corn though, options expiration happening here to round out the week. And with corn, I just feel like that the market has more potential to leak lower than it does to go higher. Partly because we got a lot of corn, but also because we just lack any sort of bullish story in this U.S. corn market right now, Chad.
Well, and I think that's the challenge. Where's the bullish story? Where might it come from? And here, I'll try to, as we're getting into the holidays, I'll try to build some holiday cheer here. If I'm going to look for a spot for that bullish news to come from, I am going to point towards exports. As we talked about with soybeans, we've seen, especially over the past couple of weeks, some definite growth on the soybean side. Well, corn has had that for the past 7 weeks. We've been seeing building sales on the export side, getting us back to where we want to be. And so I think that's going to be the potential storyline as we get out into December. If we're trying to pull prices up, it's going to be that export demand that's going to have to lead that charge. Beyond that, you're right. The idea is there just really isn't anything out there to grab onto to send us higher. But there are a few things that we can point to that, especially the supply side, that points us lower.
Well, and same kind of question I asked you about corn here. I mean, I wonder if it's a different dynamic, I believe. With soybeans, a lot of farmers selling all at the combine. That typically happens. Corn, though, I think a lot of folks are more apt to store it. But I wonder, too, I mean, should they be doing something to protect the downside risk here by, they put it in the bin? I mean, I feel like there's more potential for this corn market to go down. So I wonder risk management here, what farmers should be thinking about, Chad.
Well, that's the deal. I think as farmers are looking at their situation, you're right. They are looking to sit on this crop for a little while longer, use that storage on corn, because traditionally that's the crop that we store. But you're also right that, they shouldn't be going in just sort of store it and forget it for a while and bank on that carry to take us through here. I think in this case, what the market's sort of offering right now is a potential to put in some price floors, maybe use some options to, like I say, give ourselves a minimum price out there, and then hopefully look for that upside potential as we're going forward, but protect ourselves against that downside risk, because that downside risk is fairly strong right now. And, as we get into the holidays, if we don't see these continued exports, that continued export growth over time, we could challenge some of the lower prices we saw earlier this fall.
Well, and your role, obviously, as an economist, you are well aware of where interest rates are at. And I feel like interest rates are a much bigger conversation in agriculture than they have been in the last several years, Chad. I mean, they're a conversation throughout all facets of our economy, but in ag especially, you think about storage costs and DP and things like that at the elevator, and just the general talk around interest rates, that has a big impact on your risk management right now.
It does, because as you're right, the idea is I need to take those interest charges into account when I'm looking at storing this crop into the springtime. Am I going to get enough gain in the carry to help offset those additional costs moving forward? Now, based on what I'm seeing, at least, on where futures are going, they're trying to show that carry is building up enough to try to match what we're seeing with these higher interest rates. So the market is giving some indication of trying to reward farmers if they can hold on long enough. But you're right, it's something that we haven't had to consider over the last few years, but we definitely need to consider now as we look at utilizing that storage. Not only that, but as we think about next year and building, taking that operating note out, we need to factor interest cost into our production cost for next year, where we maybe ignored that over the past few years.
Well, and let's stay on that topic. Talk about that a little bit with me here. Operating notes and thinking about making all of our decisions, seed and chemical, fertilizer, et cetera, for next year. A lot of those decisions happen here during the holidays, ahead of tax season. A lot of those conversations with our bankers here this year are going to be a little bit different. So, I mean, as you're put on your, dig out your economist crystal ball here a little bit for us, Chad. I mean, what are some things that we want to keep in front of us, or what are some questions that we need to ask of our bankers maybe when we go in to sit down here for a year-end wrap-up and prepare for 24?
Well, that's the deal. I think we want to be having those discussions now more than ever with those lenders, laying out just, okay, where do we sit on our cost versus where we see our prices laying up right now? What are our opportunities to utilize our working capital, our cash, in the best way possible to not only meet the short-term needs on the farm, but set us up for our long-term goals on the farm? When I'm looking at production cost right now for 2024, I'm going to argue right now what I see is cost very similar to 2023 in total, but we're going to see some inputs that are going to cost more. Others, we're going to see some pullback. We're going to see some cheaper inputs out there in places. Example there, think about what fertilizer's done over the past couple of years. We've seen some tremendous swings there. Fertilizer prices are down compared to last year, but they're still elevated compared to an historical average. So that helps balance things off. Seed costs, those tend to march up slowly over time. And I'd say the biggest wild card that we're looking at right now is land. I think this year we will see higher rent costs going into 2024, but that's a category that I would look to see maybe slowing down or maybe even dropping as we move out to 2025 and 2026.
Livestock market, I think some of the similar conversations will be had here with folks at year end, especially cattle. This cattle market futures have come back down quite a bit, have taken a hit with the last, definitely the October cattle on feed report, and the November one relatively friendly to neutral, I would say. But your thoughts, just kind of managing risk here at the end of the year in the livestock markets, cattle first. What would you say to our cattle ranchers out there?
Well, that's the deal. You're right. We have seen a pullback definitely over the past couple of months on the cattle side. And a lot of that is because, let's say, the markets are trying to figure out, have we found where the bottom is in terms of the herd size and the drops in production? And in fact, one of the biggest things that I'm noticing within the cattle market is, let's call it the large variance in estimates for 2024 and 2025 production. USDA seems to be rather bullish in terms of production, as far as they're showing bigger beef production as we get out 2024, 2025 than some of the private estimates that I've seen. But if they're correct on that production, that's what's helping lead to some of these lower prices right now, because that means there's more beef to be had in the marketplace, not necessarily pushing the need for growth coming out of one of the smallest herds we've seen in quite some time.
How about the hog side? Hogs have been in a peculiar market to trade here the last couple of months. What do you think on the hog side of the equation, Chad?
Hogs have been painful just because when you think about one, we've seen, that gap between futures and cash stick out there for quite some time. And then, with the hog industry, while you look at those futures prices and they look good, we know that the cost side has been historically high, limiting any sort of profit potential for the industry. The problem is that we see both those patterns maintaining as we look out into 2024. Prices look good, but costs are going to eat through those and lead to some financial issues for the industry over time.
I know too, with this protein sector on top of the economy, we have some diseases we're fighting, and I think about HPAI in our poultry turkey flocks here. Iowa, of course, is seeing plenty of cases, and wonder some of the impacts there that could influence the beef and pork industry. What do you think, Chad?
Well, what it does do is it definitely scrambles as to the consumer choice and how they respond at the meat counter to higher prices overall. Let's face it, our consumers have held up pretty well as we've been watching all our protein prices rise over the past couple of years. As we look at HPAI, though, I mean, it's going to create some different challenges between the meats, as especially like when we had the outbreaks here in Iowa, it's been more focused on the turkey side. So that's leading to a little bit higher prices there as we're looking into 2024 for turkey. On the other hand, we know hog prices, pork prices have sort of plateaued, if you will. So it's going to make pork a little more competitive against turkey as we're looking at folks when they walk up to that meat counter. So I think that's for the challenge here, is that our consumers, their protein demand is really strong, but it is fungible. It's movable between the meats.
Well, great thoughts, Chad. Before we let you go, anything final you'd share or reiterate for folks here as we work our way into the holiday season?
Well, I've described the ending of 2023 going into 2024 as sort of a return to normalcy within agriculture. When you think about the crop side, the last couple of years have been very profitable. And now we're seeing costs rise to match where our prices are, limiting that profit potential early on here. At the same time, too, when you look at the livestock side, cattle's going through the same thing as basically the crops did, where pork was already in that economic struggle with costs and prices running in parallel here. And I think that's the challenge for farmers as we go into 2024, is managing those opportunities to capture profits when they're out there and limit the potential losses.
Great thoughts. Always enjoy a conversation with Chad Hart, economist with Iowa State University. Chad, thanks for joining us, and we'll look forward to talking to you again real soon. Appreciate the time.
Thank you, sir.